So you go to the eldest spouse. I don't even think I'm on here. Whoa, hold it. Yeah, I'm way over here. Okay. 71,000. Okay. Now, in a two-parent, say you're the eldest spouse is 44 years old, and it's a two-parent family, then the asset protection allowance is 40,300. And if it's one parent, then the asset protection allowance is only 13,900. Don't anybody ask me why it's not exactly half, because I don't know. I didn't create this, Chuck. That's just the way it is. Okay? And this changes every year. So don't try to use this thing next year. You got to come to my seminar again. Or you have to go to the Department of Education and try to find, where this stuff is. No. If there's a divorce situation, the custodial parent fills this out. The non-custodial parent is off the hook as far as FAFSA is concerned. Now, legally, morally, ethically, well, of course, the non-custodial parent is responsible for sending that young person to college, but not for the FAFSA. So this kind of helps. Look, how many people here have seniors? How many people have seniors? Okay, how many people have juniors? Okay, now you're the people that are really going to get something out of this. How are the people that have sophomores? Okay, good. Freshmen in high school I'm talking about. Okay, now you're going to really, see, you can do financial aid planning. Okay? It may be too late for you to do any financial aid planning back there in the corner. Okay? Because, if you had thought, well, FAFSA, all this, my boyfriend's making, $300,000 a year, and I'm unemployed. Maybe, we should have done the taxes a different way. So this is financial aid planning, okay, to a certain extent, and you don't want to do anything illegal. But you have there's nothing in the tax code that requires your boyfriend to put the child on his tax return. He made that decision based on the fact that he wanted all legitimate deductions he could get. But guess what? You might be better off in certain situations to forego the deductions and get the financial aid. That's where the real money is. Okay? So we're going to subtract the asset protection allowance from the net worth, and then we're going to get, if I can find my pen light, then we're going to get what they refer to as discretionary net worth, okay? So you're going to subtract the asset protection allowance from the net worth. You're going to get discretionary net worth. This number here, the spreadsheet is going to multiply that number times 12%. So your contribution from assets is going to be 12% of your discretionary net worth. And your discretionary net worth is going to be your net worth minus your asset protection allowance. This is simple math, folks. After you multiply by 12%, this, what they refer to as adjusted available income. All that is your contribution from assets added to your available income. This is where they come together. Adjusted available income. And that number there is the final number you're going to look out to get your expected family contribution. Or your expected parent contribution, by the way. So everybody turn to table A6. Table A6. Okay. Parents' contribution from AAI. I know this looks complicated. Folks, but it's basically addition and multiplication. Okay? So let's say that when you did all that, you had a minus 409,000. How could you end up with a minus? Well, it's easy. It's easy. You may not have any assets once you subtract the asset protection allowance. And once you subtract the income protection allowance from what you make, you could have a negative number. Okay? So if you have a negative number, as far as FAFSA, as far as getting by in life is concerned, that's not a good thing. Obviously, you're struggling to get by. But for FAFSA purposes, you're golden. I mean, you're going to end up with you could end up with basically a negative AAI, which means it's the same thing as a zero EFC. You don't have to, you're not expected to contribute to your son or daughter's tuition. Now, if that number is anywhere between 14,601 and 18,400, then it's a simple formula. You take your expected parent contribution is going to be $3,212 plus 25%. You know, I'm kind of standing in the way of everybody over here. It's going to be 25% of everything over 14,600. Okay, so you take whatever your AAI is, and you subtract 14,600 from it, and then the difference you're going to multiply by 25%, and you're going to add that to 3,212. Okay, all right. So you take this number here, which is 3,212, and you add that to 25% of your AAI over 14,600. So you take your AAI, you subtract the 14,600, and you get everything over 14,600, and then you add that to the $3,212. And if you don't remember anything else, I want you to remember, you divide, if you have one child in college, you divide by 1. If you have 2 in college, you divide by 2. If you have 3 in college, you divide by 3. Number of children in college. It makes a huge difference, correct? I mean, I've had a lot of people that came to my seminars when the first child went to college and they weren't eligible for financial aid and they stopped coming. And big mistake, right? Because the next time their expected family contribution is cut in half for each child. Going forward, what I'd like to do is talk a little bit now about financial aid planning, okay? Now, if your son or daughter is a senior in college, you may find that you should have come to this seminar 2 or 3 years ago, okay? This is financial aid planning. What can you do? What can you do to lower your AGI? This, this guy down here, this number 37 on your tax return. The best way to save for college, bar none, is a Roth IRA. It's a Roth IRA. It's a Roth IRA for you. It's a Roth IRA for your spouse. It's a Roth IRA for your students themselves. You know, when they work at the grocery store and, they make $2,000 for the year, you can take $2,000 and put it in an IRA for them. But put it into a Roth IRA. Because when you take money out of a traditional IRA, well, that becomes income, okay? That goes over here. And that's a bad thing, okay? So one of the things we're talking about now is financial aid planning, okay? What you never, ever, ever, ever want to do is take money out of your 401k plan or your IRA to pay for college. Because that's going to be counterproductive. Why? Well, first of all, unless you're an old guy like me, you're going to pay a 10% penalty, and you're also going to pay taxes on that at whatever tax bracket you're in. But not only that, but it's going to inflate your income for that year, and it's going to increase your AGI and make you less eligible for financial aid. So that is an example of very, 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 very poor financial aid planning. Waiting until the last minute and then taking money out of your 401k. That's a disaster. It's a disaster for you as a parent. You shouldn't have to give up your retirement savings to send your young person to college. Another thing you don't want to do is you don't want to sell anything that's appreciated. You got a bunch of stock out there, and you're going to have to liquidate some of that to pay for Johnny's tuition. Well, what do you sell? You don't sell the stuff that's appreciated. You sell the stuff that has depreciated. Because you can take a $3,000 write-off, every year until you get rid of those losses for the next 4 years while Johnny's in college, and you reduce your AGI, make yourself more eligible for financial aid. If you sell the stuff that's appreciated, that's going to inflate your income, and, it's not going to be a good thing. Okay? So don't sell anything that's appreciated. Don't sell that lot of yours. Because, if it's depreciated, you can sell it. But if it has appreciated, don't. Okay? Because not only are you going to have the asset after you sell anyway, but now it's going to appear on your tax return. So you're going to get a double whammy. You got the asset now, and you also got the income. And the income is much more important than the asset, remember? Because your income, they can use up to 47% of your income, but they can only use up to 5.6% of your assets. Because once you take that 12% and then go to that table where you get your AAI, you're down to 5.6%. So your assets are not as detrimental to getting financial aid as the income is. Okay? Let's take a look at this one. Okay, this is Schedule C. Does anybody know what Schedule C is? Do we have any people that file Schedule C in here? Excellent. Anybody else? Schedule C, that's if you're self-employed. We only got one guy in here that's an entrepreneur too. All right, any other entrepreneurs? Okay, you guys are in luck. You know why? Because everybody else, their employer determines how much they make. And they get a W-2. And there's nothing you can do with that. That goes over here on box 1 and it ends up on your AGI, and there's nothing you can do about it. You guys determine how much money you're going to make. Okay? If you invest in a vehicle for yourself, you go out and you buy a Humvee, okay? And I tell people that FAFSA has such loopholes in it that you can drive an SUV right through it. You guys go out and you buy yourself an SUV, you end up with a negative $30,000 on your Schedule C down here. And I hope you guys are taking advantage of the home office deduction. Because that's the biggest lie out there, that the home office deduction will precipitate an audit. That's a bunch of baloney. What that is that's a lazy tax preparer. Okay? But if you load this thing up with expenses and assets and things like that you buy, you know when you do it? You buy it during the base year, the first year. Because the first year for FAFSA is the most important. And I'll tell you why. Colleges do not want to be known for lowballing the first year. Giving you a great offer the first year and then cutting it back the second, the third, the fourth. If they get known for that, they're dead. And they're all in competition for the best students, right? So the last thing they want to do is be known for lowballing. So chances are what you get that first year, you're going to get at least that for the next 2 or 3 or 4 years. So that first year, you guys go out, you buy yourself an SUV, you drive that truck right through the FAFSA, and you get a negative $30,000 down here, and that reduces the income that your spouse makes, and all of a sudden you're looking pretty as far as FAFSA is concerned. Okay? Why? Because you did some financial aid planning. Okay? You understood the process. You took a look at my spreadsheet and you said to yourself, well, you know what? If I, took this money and did this with it or that with it, and if I did this or that with my, my personal business, well, you calculate what your expected parent contribution is, you start playing around with that spreadsheet. That's called financial aid planning. Make yourself more eligible for financial aid. Don't be a sheep, just ready to be shorn. Just go in there and listen to what they say. Oh, you just fill in the blanks, folks. That's what they tell you at the high school. When you go to the high school, I've been to the high school FAFSA seminars. I've been to the college workshops, and they don't tell you anything. Now, what else can you do? Okay, that's Schedule C. What about this one? Schedule D. This is where you can sell your appreciated assets and then take those losses, $3,000 a year, lower your AGI, for 4 years or 8 years, however many years. A lot of people have a lot of losses out there. You could do the same thing with investment property. Now, there's an idea for you. You've got an investment property out there, and you've taken a huge loss on it, and you sell that sucker. Get rid of it. And take those losses and carry them forward. Okay. This is Schedule E. Is there anybody fill out a Schedule E here? Does anybody have rental properties? I'm the only one? Excellent. We got an entrepreneur back there in the corner. All right. Now, this gentleman invests in rental properties because he knows that once he, takes his mileage up here, and I hope you're taking your mileage back and forth, once you take your property taxes and all your repairs on an annual basis, and then boom, once you calculate that depreciation, take the cost of that home, divide it by 27 and a half years. You know what we do for our clients is we separate out from the shell of the home, we separate out the appliances, the landscaping, the power plant, the HVAC systems. You can separate all that out and depreciate it on a separate schedule. You don't have to divide everything by 27 and a half. That's a lazy taxpayer right there. Just how much you pay for it? Oh, $100,000. Okay, well, we'll take that. We'll divide it by 27.5%. Not exactly the way you should do it. You should break out all those, those minor assets from the shell of the structure and depreciate those on a separate schedule. It's called cost allocation. Perfectly legal. So, at any rate, so you've got these rental properties, and down here, this is a negative number. Well, guess what that negative number does to your AGI? Okay? In the meantime, you're taking all those rents and you're stuffing your pockets with them, but you're using that to live on, and it's paying the bills, and it can pay for Johnny's college education. But the bottom line is still negative. Reduces your AGI, makes you what? More eligible for financial aid. It's called financial aid planning, folks. Okay. Now, this is the real deal. Okay? You already know what most of these boxes are. I'm just going to explain a few more. Why the heck are they asking you on the FAFSA for dad's income at work and mom's income at work? The whole thing is based on the AGI, which includes mom's income and dad's income. So what the heck, are they doubling all these things up? No. The reason why they ask you what mom makes for work and what dad makes for work is you're going to get a deduction for that. They're going to give you credit for that. They're going to reduce your income by the amount of Medicare and Social Security you pay. That's why they ask you that question. Now, when they ask you that question, and let's see how many smart guys we got in the room. When they ask you that question, how much do you make from work? Now, they told you when you went to those FAFSA seminars that it was simple, right? Well, we found out from the get-go that who's the parent is not even a simple question. Now the question is, how much does mom and dad make from work? The purpose of asking what mom and dad makes for work is to give mom and dad a deduction. And you're entitled for a deduction on all your 401k contributions because you were taxed on that before it went into your 401k plan. Some of you may not realize that. You put it in your 401k plan because you don't want to be taxed income tax on that. But you are taxed at Social Security and Medicare on that money. So which box should you use? I would use box, Mike, come on. You would say box 5. That's Medicare because Social Security, they only tax you up to $107,000. And if you're making $107,000, you need every deduction you can get. So Medicare, they tax you all the way up to infinity on your Medicare. Okay? So the total amount of gross earnings is going to be in box 7. That's the one I would recommend you use, box 7. Yes, Mike?
You said box 7, it's actually box 5.
It's actually box 5. Okay. Social Security tips, right. That would be if you're a waitress. Sorry. Okay. Or a waiter. Okay. Let's move forward. All right. So now I've given you some ideas as far as planning is concerned. And one of the other deductions, and I'll show it to you on the next slide, is based on your state taxes. Remember I said they give you credit for your Medicare and your Social Security. They also give you credit for your federal taxes, and they're going to ask you what you're paid on your federal taxes. That's a question. The reason why they're asking that is that you want to get credit for that, okay? So you want to use the right number. And this is for Illinois. It's 5%. Guess what? Because that's the 5% state tax, so you're going to get credit for that, okay? And this is where you get credit for your Social Security, Table A2, Social Security, Medicare, et cetera, okay? We already went through this, the income protection allowance. Okay, so here's this is where you have your state tax allowance over here. These are deductions down here now. We already calculated what your income was, okay? Oh, we didn't. We need to do this part here. This box here is on the second page of your spreadsheet. You'll see question 95AI. Those are the things that go there. They're pretty self-explanatory. And then this is a subtraction over here. This is less. And this is where your state taxes come in and some of the other things that you can deduct. Okay? And those are the things that are labeled 94A through items A through E. Okay? So you're going to fill in these boxes here. Once you do that, these boxes here are going to be calculated for you for your state tax allowance, mom and dad's Social Security based on the numbers you put up here. And then we're going to subtract the income protection allowance, which we already know what it is because we already looked it up. And then from there, we get down to this, employment expense allowance, okay? If you're a two-parent family, they give you an extra $3,600 of deduction just because you're two workers, okay? So it's a good idea to have both spouses work for lots of reasons, you know, during the college years because you need that extra money, and you also get a break on the lower income, the income from the spouse that makes the lesser amount. Okay, you get an additional $3,600, or it's 35% of whatever that lower spouses, the spouse's lower earnings. I don't want to call her him or her the lower spouse, but I think you get the idea. This is a shotgun approach to well, who thinks the U.S. government divides money up properly? Huh? How could you do it even if they were extremely efficient at it? How would you do something like that? That's why they came up with this system. The reason why they haven't changed it is it's so lousy, you know, that they can't even figure out how to make it better. So they decided to, you know, let the financial aid officers get some discretion to try to make it a little more fair. They made that change in 2009, which was a good one. Okay, now we're down to where we were before, available income. You know what cash is. We've been through this before. Your investments, you know, get rid of that cash. Don't go through this, you know, with a lot of cash. And your discretionary net worth, we've been through all this before. Okay? So now you're all experts. You're going to give me your email on your little fill-out form there, and I'm going to send you my spreadsheet, and you guys can just play away. Okay? Financial planning. Now, one final thing. I want to explain the difference between, and these are very important differences, between when the student fills this out and when the parent fills it out. Okay? Now, this isn't set up for the student, but remember, the income protection allowance was, you know, multi-thousands of dollars for the parents. For the students, the income protection allowance is $6,000. Is it 6,000, Mike, or 62? No, it's more. It's up to 6,000 now. So it doesn't make any sense for your student to make more than $6,000. Now, remember that the most they can take from your income is 47%. Okay? Everything over $600 that the student makes raises your expected family contribution dollar for dollar. Okay? Now, there's one exception. Very, very important exception. If your student is eligible for financial aid in a prior year or in this year, and he or she is offered a work-study program at the college, then the student can make an unlimited amount of money in the work-study program. It doesn't count against them for FAFSA. Only the money that the student makes during the summer or outside, otherwise outside the work-study program. And I think work-study programs, I think even some students take a work-study program throughout the summer. They just stay at the college and do that. But anyway, that's not included. And there's a question on the FAFSA, you know, about the student's income. And how much income came from, what do they call it? Christine? The work-study question on the FAFSA? How much money came from, they don't use that term. What's the term they use, guys?
College work study?
Well, they don't say college work study. They say something else. Federally, blah, blah, blah. Federal work study program or something like that. They ask you that question on the FAFSA, so you want to fill that out properly so that, you know, that doesn't raise your income. The other thing, the other very, very, very important thing is the student's asset protection allowance. Okay? And I mentioned that earlier. The student's asset protection allowance is 0. And where your assets are multiplied by 12%, the student's assets are multiplied by 20%. And there's none of this, go look at the table. That's it. It's 20% of the student's assets, and it's 100% of the student's income over $6,000. Yeah. So it makes absolutely no sense whatsoever for Johnny or Sally to carry any assets through college. Get rid of them. Trust funds are an absolute disaster when it comes to FAFSA. Because if a student has a trust fund, that's an asset of the student, it's a dumb idea. The lawyer who set it up for you should be disbarred, as far as I'm concerned. Okay? Thanks for coming, folks. It was the smartest movie made all week.